Module 7. Expenses and Earnings. Minimum Legal Capital. Minimum legal capital is a company's minimum capital to operate or conduct business legally, and it is also known as minimum paid-up capital or minimum share capital. The minimum legal capital requirement varies by jurisdiction and industry. Government regulatory bodies or other authorities may set it. A corporation's minimum legal capital is established by recording the par or stated value of the number of shares issued. In some jurisdictions, the minimum legal capital requirement is intended to protect creditors by ensuring that the company has sufficient funds to cover its debts in the event of insolvency. In other cases, the requirement may regulate competition or promote industry stability by limiting the number of companies that can enter a particular market. For example, in the United States, corporations have no federal minimum legal capital requirement. However, individual states may have their minimum capital requirements, ranging from a nominal amount, such as $1, to a substantial sum, such as $500,000 or more. Companies must comply with the minimum legal capital requirement, as failure can result in fines, penalties, or even legal action. Additionally, having adequate capital can help ensure that the company can meet its financial obligations and pursue growth opportunities over the long term. Prior period adjustment. A prior period adjustment is an accounting change that relates to a previous accounting period and requires the restatement of previously issued financial statements. It is used to correct errors or omissions in the financial statements made in previous periods. Prior period adjustments are necessary when an error or omission is discovered in the financial statements of a previous period that materially affects the accuracy of the information reported. The adjustment must be made in the financial statements for the period in which the error or omission occurred, and it must be disclosed in the financial statements for the current period. Prior period adjustments can be made for a variety of reasons, including correction of a mathematical error or mistake in accounting, changes in accounting principles or policies that were not correctly applied in prior periods, discovery of fraud or embezzlement that impacted prior periods, and changes in estimates or assumptions made in prior periods that were incorrect. Prior period adjustments are recorded as a cumulative adjustment to the opening balance of retained earnings or other equity accounts. The adjustment is shown separately on the financial statements and typically includes a description of the reason for the adjustment and the impact on the financial statements of the affected period. Prior period adjustments are essential for ensuring the accuracy and transparency of financial reporting, and they are subject to review by auditors and regulators to ensure compliance with accounting standards and regulations. For example, a company should have calculated and reported amortization expenses in year 1. The error was discovered in year 2, and the item should be reported as a prior period adjustment on the year 2 statement of retained earnings. Organization expenses. Organization expenses are costs incurred by a company when forming a new business entity, such as a corporation or partnership. These expenses are incurred before the company begins its normal business operations and can include a wide range of costs associated with incorporating, setting up the legal structure of the business, and preparing for the start of operations. Examples of organization expenses can include legal fees related to drafting the company's articles of incorporation, bylaws, and other legal documents, accounting and auditing fees related to organizing the company's finances and records, costs associated with registering the company with the appropriate government agencies and obtaining necessary permits and licenses, and fees are paid to consultants or advisors who guide the formation and organization of the business. Under GAAP accounting rules, organization expenses are considered a type of startup cost and are generally classified as intangible assets. These costs are not immediately expensed when incurred but are capitalized and amortized over a while, usually 15 years, using the straight-line method. Organization expenses are also typically subject to certain limitations under tax law. In the United States, for example, the Internal Revenue Service allows companies to deduct up to $5,000 in organization expenses in the year the business is formed. Any additional organization expenses must be amortized for 180 months or 15 years. It is crucial for companies to correctly identify and account for organization expenses, both for financial reporting purposes and for tax purposes, to ensure that they are accurately reflecting the costs associated with forming the business entity. Dividend yield. The dividend yield is the ratio of the annual cash dividends distributed to common shareholders relative to the current market price of the common stock. It is calculated by dividing the annual dividend per share by the current market price per share. The dividend yield is expressed as a percentage and is used by investors to evaluate the potential return on their investment in a company's common stock. A higher dividend yield can indicate that a company is paying out a more significant percentage of its profits in the form of dividends, which may be attractive to income-seeking investors. However, a high dividend yield can signal that the company is facing financial difficulties or needs to invest more in its future growth. The other options listed are also essential measures for evaluating a company's financial performance and stock value. Current yield. This is another term for dividend yield and represents the annual dividend payments as a percentage of the current stock price. Earnings per share. This is the company's net income divided by the number of outstanding shares and represents the earnings that can be attributed to each share of common stock. The dividend payout ratio is the percentage of a company's earnings paid out as dividends to common shareholders. It is calculated by dividing the annual dividend by the earnings per share. The price-to-earnings ratio is the current market price per share divided by the earnings per share and represents the price that investors are willing to pay for each dollar of the company's earnings. A high price-earnings ratio can indicate that the market expects the company to have strong future growth potential. The total assets ratio is the cash flow on total assets ratio and is calculated as cash flows from operations divided by average total assets.